Welcome to the Deep Dive. This is where we take those big, pressing, global questions, look at a whole stack of carefully chosen sources, and really pull out the essential insights you need to be truly informed. Today, we are diving headfirst into something that's, well, it feels like more than just a headline, doesn't it? It feels like a tremor under our feet.
Yeah, definitely.
We're talking about the potential for U.S. election chaos to send, well, pretty profound shockwaves across the entire global economy.
It's a huge topic.
It really is. I mean, think about it. An election in just one country, even a really significant one like the U.S., holding such immense sway over global financial stability and, crucially, over your own finances, too.
Right.
Now, you've shared a recent, very comprehensive analysis looking specifically at this, looking at the potential risks, the reactions we might see.
That's right. It maps out some key possibilities.
So our mission today is pretty clear. Unpack those connections, explore the what-ifs that keep markets on edge, and give you clear insights to navigate this.
Yeah.
Let's dig in.
Absolutely. And I think the starting point has to be why. Why do American elections matter so much everywhere else?
Exactly.
Because we're not just talking about an economy here. We're talking about the world's largest economy. But, a pretty wide margin.
And that size isn't just a number, is it? It has real-world clout.
Immense clout. It's not just a dry statistic. It has tangible implications for, well, pretty much every other nation, every market, everyone connected to the global financial system.
How big are we talking in perspective?
Well, think about this. The U.S. economy makes up around, 25% of global GDP? A quarter of the whole world's economic output.
Wow, a quarter.
Yeah. And it's consumer spending alone. It's this colossal engine. It drives demand that keeps factories humming in Asia, shipping companies busy in Europe, resource suppliers in Africa and South America working.
So if U.S. consumers pause.
Exactly. If American consumers just, tighten their belts even a little bit, that decision sends ripples through countless global supply chains. It affects jobs, revenues, everything far, far beyond U.S. borders.
That's a powerful picture. The U.S. as this dominant force pulling a quarter of the weight, but it's more than just size, right? You mentioned the dollar earlier. How does that amplify the impact?
You've hit on a really critical point there. Beyond the sheer economic weight, the U.S. dollar, it has this unique, almost unparalleled position. It's the world's main reserve currency.
Reserve currency, what does that mean in practice?
It means that the vast majority, maybe 60%, some estimates go up to 80% of all international trade. It's done in dollars, or at least priced in dollars.
Oil, commodities.
Oil, metals, microchips, you name it. And countries all over the world hold huge reserves of U.S. dollars, U.S. Treasury bonds. Not just as investments, but to back their own currencies, stabilize their economies, make international payments possible.
So if the U.S. system looks shaky,
then the whole global system feels it. Any big swings in the dollar's value, or worse, any prolonged uncertainty about the U.S. economy or its governance, that translates directly into instability for everyone. Well, when the dollar jumps around erratically, it messes with the cost of imports and exports for every country. It changes the value of international debt that's held in dollars. It impacts the buying power of businesses, individuals worldwide. It's not just numbers. It's about setting the global tone, about reliability.
And this is where it gets really interesting, I think. That global tone you mentioned, it goes way beyond just finance, doesn't it?
Oh, absolutely.
It touches things like global trade policies, allies with whom geopolitically, even just broader political stability everywhere.
Yes, it's all interconnected.
It's like the U.S. is the central engine in this incredibly complex global machine, right?
That's a good analogy.
And if that engine sputters, even coughs a bit,
yeah,
any hint of uncertainty in America, you feel those vibrations right through the whole system. Instant. It's not just Wall Street reacting anymore. It's about that fundamental stability, that predictability the world relies on.
Exactly.
So when that predictability gets questioned, the anxiety is immediate. It's widespread. So what are the specific ways, the mechanisms that could actually turn that anxiety into real economic disruption?
Right. Given how important this all is, we need to understand the specific triggers. How could an election actually cause global economic problems?
Yeah.
And the analysis points to several scenarios. And it's key to remember, often it's not the final outcome that causes the most immediate trouble. It's the process of getting there.
The uncertainty itself.
Precisely. The first big risk is simply delayed results.
Right. We expect a winner on election night, don't we?
We do, in this age of instant news. But history shows states often take days, sometimes weeks, to certify results. especially if it's close or if there are lots of mail-in ballots, complex counts.
And in today's climate,
In a highly polarized environment, that normal delay could get seriously amplified. Imagine weeks without knowing who's leading the country.
what would that do?
Well, think about it. Major investment decisions put on hold. Consumer confidence, stagnant. Global capital just sitting on the sidelines, paralyzed because nobody knows what's coming next.
And that uncertainty, that waiting, it can easily feed into more direct challenges, can it?
Exactly. Which brings us straight to the second major risk. The source highlights legal battles.
We've seen this before.
We have. We've seen how extensively litigation can be used to challenge votes, counting procedures, even the basic validity of the election itself.
And these aren't small disputes.
No, not at all. They can go through local courts, state Supreme Courts, all the way up to the U.S. Supreme Court. And these huge legal fights can stretch out the whole resolution process for weeks, maybe months.
Preventing a clear winner from emerging.
Right, and leaving the entire country, and frankly the world, in this state of suspended animation, just guessing about leadership, about policy direction. It creates this deep erosion of trust in the institutions themselves. That's arguably even more damaging long term.
And alongside the legal fights, unfortunately, we've also seen the potential for things to spill out onto the streets. That adds another layer of, well, unpredictability.
Precisely. Which leads to the third risk, mass protests.
Yeah.
If the outcome is contested, or if people perceive irregularities, there's a very real chance of widespread public demonstrations.
Peaceful protest is part of democracy, of course.
Absolutely. But even peaceful protests can have economic impacts if they block streets, scare off customers, disrupt transport, and if they escalate.
Then you get property damage, businesses closing.
Disruptions to supply chains, exactly. The mere fact of widespread unrest, whatever its nature, signals instability. It erodes public confidence and, crucially, investor confidence, too.
And the worst-case scenario there?
Well, the most extreme scenario, and one we sadly have to consider based on recent history, is the potential for civil unrest or actual violence.
God forbid.
When political divisions are this deep, emotions this high, there's always a risk it could spill into direct conflict that further destabilizes everything, creates real fear, makes normal economic activity incredibly difficult, if not impossible.
The economic impact there is pretty direct.
Very direct. Destruction of property, people unable or unwilling to work, a total freeze on any kind of investment. And all of these things, the delays, the legal fights, the protests, the potential unrest, they all feed directly into investor sentiment. That's where the economic impact really starts hitting home.
Because investors hate uncertainty.
They despise it more than almost anything. Whether you're talking about someone managing their retirement savings or a huge institutional fund managing trillions, their main goal is to assess risk accurately, make informed decisions based on predictable outcomes, clear policies.
And when that's gone?
When the election outcome is unclear, when the rules seem like they might change, when there's a risk of social disorder, the ability to plan just evaporates, risk assessment becomes impossible, and fear takes over.
So money moves out.
Money flows out of anything seen as risky. Capital just sits on the sidelines, waiting for clarity. And that paralysis, that fear, it can be profoundly damaging to markets, often leads to sharp, sudden drops.
So, okay, when this kind of political drama hits, what should we expect to actually see? In the financial news headlines, in our own portfolios maybe, on those market tickers, what are the typical immediate reactions?
Well, the reactions are often quite predictable, actually. Though, how big they are depends on how bad the uncertainty is and how long it lasts.
Okay.
The most common first response. Stocks drop, sometimes quite sharply.
The classic de-risking move.
Exactly. Investors pull capital out of stocks because they're more sensitive to economic disruption and policy uncertainty. They're worried about companies earning less because of potential slowdown, or just general unease about where policy or regulation is heading, or even basic governance.
We've seen this happen, right?
Big drops. Well, yeah. In past periods of serious political uncertainty, major indexes like the S&P 500 have dropped, 5%, 10% even, in just days or weeks. That's trillions in lost market value. Companies just become less valuable when their future is cloudy. And alongside stocks, you see big dollar swings. This one's a bit more complex.
How so?
Well, sometimes, initially, if there's a global crisis starting outside the U.S., the dollar might actually get stronger, a sort of safe haven effect. Global money might flow into U.S. treasuries seeking stability.
But if the uncertainty is inside the U.S.?
Right. If it's prolonged uncertainty within the U.S., or worse, a real questioning of America's ability to govern itself, That could lead to the dollar actually weakening over time.
What would that mean?
If the world loses faith in U.S. stability, the dollar's role as the main reserve currency could be challenged. That would make imports way more expensive for the U.S., potentially fueling inflation here. And it could cause huge problems globally for countries holding dollar debt. And of course, when investors run from risky assets, they often pile into safe havens, right? So those prices spike.
Like gold.
Gold is the classic example, yeah. People see it as a tangible store of value. Demand goes up. U.S. Treasury bonds, ironically, might also see more demand initially because they're seen as the world's safest government debt. Deep market, very liquid.
But you said the dollar could weaken? Would that affect treasuries too?
It could, eventually. If a crisis really questions U.S. governance long-term, even treasuries might lose some of their safe haven appeal. Investors might demand higher interest rates, higher yields to compensate for that perceived risk, especially if worries about the U.S. debt ceiling or its ability to pay its debt surface.
Any other safe havens?
Sometimes, certain stable currencies, like the Japanese yen or the Swiss franc, benefit. Money flows the country is seen as politically and economically solid.
We've talked about these reactions kind of theoretically, but we've also lived through moments like this. Can you give us a concrete example? Maybe walk us through one.
Absolutely. The 2000 U.S. presidential election is really the textbook case study here. Bush versus Gore, the Florida recount.
The hanging chads.
Exactly. That intense uncertainty dragged on for over a month. 36 days, I think it was. The entire financial world was just holding its breath.
And the markets.
During that period, the S&P 500 index dropped over 5%. Billions in market value just vanished. Tech stocks, financial stocks, the ones really sensitive to stability, got hit particularly hard.
So it wasn't just hypothetical, real money lost.
Real money, real confidence lost. Businesses put off investments, consumers got nervous, the paralysis was obvious. It really hammered home how vital a clear, timely democratic process is for the economy, no matter who actually wins in the end.
And what's sort of unnerving here is that, 2000 feels like a while ago now. The world is so much more interconnected today, isn't it?
Massively more interconnected.
Information moves faster, money flows faster, global dependencies are way more complex. So logically, a similar period of prolonged uncertainty today could trigger an even faster, maybe even more dramatic global reaction.
That's the concern, yes.
Yeah.
The potential for contagion is much higher.
Okay, so we've outlined the sort of typical market reactions, but let's push this. What are the scenarios that really, truly terrify the big players on Wall Street? What are their absolute worst fears when they game out potential U.S. election chaos?
Yeah, this goes beyond just, a few days of unclear results. The deepest fears are about scenarios that fundamentally attack the credibility, the stability of American institutions themselves.
Like what specifically?
First on that list would be a prolonged, really deeply contested election. Not just a week's delay. We're talking weeks, maybe months, of nonstop legal challenges, recounts, public fights over legitimacy.
So it's not just about who wins anymore.
Exactly. It becomes about whether the process itself is trustworthy. If the world's biggest economy, this supposed beacon of stability, can't clearly and cleanly pick its leader, that sends a really chilling message globally.
And the market reaction?
It wouldn't just be volatility. It could be a systemic repricing of all U.S. assets. Global investors demanding much higher risk premiums, or maybe just pulling their capital out altogether. Another huge concern is widespread mass protests, especially if they go beyond peaceful marches and turn into serious disruption.
Disrupting daily life, business.
Right. Protests that paralyze cities, stop businesses from opening, block supply trucks, lead to significant property damage. These aren't just symbolic. The economic impact is immediate and severe.
How so?
It's direct revenue loss for businesses. It's a breakdown in national logistics. It's a chilling effect on investment, both domestic and foreign. Investors start asking, is it even safe or operationally possible to do business here? It's a direct challenge to the rule of law and social order that business relies on. And then there's the scenario that probably causes cold sweats, a government shutdown.
If the election mess leads to gridlock.
Exactly. If it's so contested that political factions just refuse to cooperate, maybe they can't even pass basic funding bills. A shutdown means non-essential federal services just stop. National parks close, economic data doesn't get processed, government contractors don't get paid.
That sounds chaotic.
It signals deep dysfunction right at the heart of government. It has immediate economic consequences, and it really erodes confidence globally in the U.S.'s ability to even manage its basic financial affairs. That has huge implications for its creditworthiness.
So the core fear here, it's not really just about specific policy changes like tax rates or regulations, is it? It sounds much more fundamental.
Precisely. That's the key insight. The core fear for Wall Street and really for global markets is any widespread sign that America simply cannot govern itself effectively and predictably.
That's the ultimate red flag.
It absolutely is, because it undermines the very foundation of everything. Economic predictability, the rule of law, investor confidence, not just here, but everywhere that relies on the U.S. system.
What would signal that? What specific signs would tell global investors, okay, this is serious?
Well, things like clear statements from major political leaders refusing to accept legitimate results, sustained challenges to court rulings, especially from high levels, maybe even military leaders feeling the need to publicly reaffirm civilian control, or just a prolonged inability to actually form a functioning government.
And if that perception takes hold?
If that perception takes hold, it forces a massive reevaluation of U.S. assets, a flight from long-term commitments. The implication is dire. It could trigger a huge global sell-off, way beyond a normal market correction. It signals systemic risk, not just a cyclical downturn. And if America were to wobble like that, profoundly, the ripple effects around the globe would be immediate and severe.
How so? Where would we see it first?
Well, other major economic blocs are just directly dependent on U.S. stability. Take Europe. European economies have really strong trade ties. Think high-value goods, luxury items, and deep financial market links with the U.S. If confidence in the U.S. tanks, European banks holding lots of U.S. assets, or companies relying heavily on U.S. consumers, think German cars, French luxury goods, they'd feel immense pressure instantly.
A U.S. slowdown means a European slowdown.
Pretty much directly, yeah. Affecting everything from manufacturing to services. It could easily push the Eurozone towards recession. And then look at Asia. The impact there could be just as big, maybe even bigger.
Why is that?
So many Asian economies, China, Japan, South Korea, Taiwan, Vietnam, are huge manufacturing hubs, very export-driven. They rely heavily on Americans buying their stuff.
So if U.S. consumers start buying,
it hits their export revenues hard, leads to factory slowdowns, job losses. Plus, U.S. foreign investment is crucial in many of these economies. Uncertainty can mean massive capital flight out of Asian markets and much less new investment coming in. That really stifles growth. And then you have the emerging markets. Often they are the most vulnerable.
Why them specifically?
They rely heavily on global capital flowing in to fund their development and manage their national debt. When uncertainty hits, that global capital tends to flee risky assets and run towards perceived safety.
So money leaves emerging markets.
Exactly. Significant capital flight. That can trigger sharp drops in their currency values, making imports incredibly expensive. And it makes servicing their foreign debt, which is often in dollars, much, much harder, maybe impossible.
And borrowing costs.
Their borrowing costs shoot up dramatically. It stifles growth, can increase poverty, potentially even lead to social unrest within those countries. It's a really dangerous cycle.
So if America wobbles, let's broaden out again. What are the specific sort of global scale outcomes we'd likely see beyond those regional impacts?
Okay, yeah, zooming out, we'd expect several immediate widespread consequences touching pretty much every corner of the global economy.
Like what?
First, global trade would slow down dramatically. Uncertainty just paralyzes confidence, both for consumers and businesses everywhere.
People stop spending, businesses stop investing.
Right. Consumers hesitate, businesses postpone investments, pause hiring, cut back expansion plans. That means lower demand for goods and services crossing borders. The whole intricate web of international commerce just starts to seize up. Shipping lanes get quieter, export economies suffer hugely. Second, currencies would swing wildly.
We touched on the dollar, but this is broader.
Much broader. Major currencies, minor currencies. They'd all experience significant volatility against the dollar and against each other. This makes international business incredibly risky and hard to plan.
How so?
Businesses wouldn't know the real cost of their imported parts or the true value of their export sales from one day to the next. Long-term contracts become dangerous. Hedging against currency risk becomes super expensive. It can lead to competitive devaluations, maybe even currency crises in vulnerable countries. And thirdly, foreign markets would likely crash.
Stock markets everywhere.
Stock markets, bond markets, in many other nations could see sharp declines. It wouldn't be just a U.S. problem. It would reflect this global contagion, this widespread loss of confidence, a systemic shock to the whole global financial system.
A synchronized global downturn.
Very likely. Fear and uncertainty would just override everything else, which, raises a really important question. How can anyone, individuals in markets, from New York to Tokyo to Lagos, How can they possibly prepare for effects this widespread when the very foundation seems shaky?
Yeah, it's clear the waves would hit every shore. Now, let's circle back to those historical examples again. We talked about Bush-Gore in 2000, and of course, the 2020 election had its own tensions. What are the lasting lessons from those moments, especially for financial markets?
Well, 2000, the Bush-Gore recount, it really is the classic case. As we said, markets lost billions. But the key takeaway is the duration of the uncertainty. Over a month, right? 36 days.
Agonizing days for many.
Absolutely. The world was just guessing who the next U.S. president would be. This long legal and political fight just created this environment of profound unpredictability.
Paralyzing decisions.
Exactly. Big financial firms, businesses, investors, they just held back. They feared unknown policy changes, maybe a chaotic transition. And the S&P 500, like we said, dropped over 5% just during that recount period. That shows the direct economic cost of just waiting. Even if the process itself was, constitutional, the delay hurt. Then fast forward to the 2020 election. Now, the outcome there became clearer sooner than some fear, but there's still significant anxiety, wasn't there?
Oh, yeah. Definitely leading up to it and immediately after.
Right. Markets were braced for potential chaos. The fears of widespread unrest, of major legal challenges, maybe even a refusal to concede that created real nervousness among investors.
Even though markets recovered relatively quickly?
They did recover relatively quickly once a path seemed clear enough. But that initial caution, that readiness for disruption, was very visible. Futures markets were volatile, the VIX the fear index spiked. It showed that even just the threat of chaos is enough to make markets jittery.
So if you put those two together, 2000 and 2020, what's the core lesson? It feels like a consistent pattern.
It is remarkably consistent. In both cases, whatever the final outcome, uncertainty was the real enemy for financial markets.
Not necessarily who won or lost.
Less about who won and more about the lack of clarity about how the winner would be decided and the stability of the process itself.
Is there ever a time when that's not true? Do markets ever just shrug off this kind of uncertainty?
That's a really good question. Markets can handle certain kinds of uncertainty, maybe cyclical stuff they expect, but this kind of deep political institutional uncertainty, it's different. It's fundamentally damaging because it paralyzes basic decision-making.
The lifeblood of the economy.
Exactly. Businesses don't know the rules. They delay investments, stop hiring. Investors can't assess risk. They pull capital out, or they park it in the safest, lowest return places. That dries up productive investment, stifles innovation, breeds speculation instead of real activity.
So no real historical examples of markets doing well amidst chaos.
Not really, not in prolonged foundational political chaos. Short crises might see a quick rebound once there's clarity, sure. But persistent doubt about a country's basic governance structure, that's almost always a net negative for growth and confidence. Markets crave clarity, predictability. Political chaos is the opposite. That pattern just underscores how vital a clear, accepted, timely democratic process is for economic health.
Okay, so looking at right now, this moment, are we just facing a potential repeat of history, or is there something fundamentally different about today's landscape that makes these risks even, bigger? Why should we be paying even closer attention now?
That's a critical distinction, yeah. History gives us lessons, but the current context definitely introduces some amplified risks. Things that could make any disruption potentially much worse.
Like what?
Firstly, just increased global interconnectedness. The world economy is way, way more intertwined than ever before. Supply chains are incredibly complex, often just in time. A disruption anywhere spreads incredibly fast.
And financial markets?
Instantly linked. High-frequency trading, complex derivatives, information zipping across borders in milliseconds.
Right.
It means a crisis here in the U.S., it could go global in hours, not days.
Leaving less time to react.
Much less time for markets to adjust or for policymakers to try and coordinate some kind of response. The contagion effect is just much faster, much more pervasive than even 20 years ago. Secondly, you have social media as an accelerant.
Yeah.
The speed and scale at which information and critically misinformation or just sheer panic can spread now is unprecedented. In a contested election, this can amplify fear exponentially. It makes it harder to control the narrative, harder for individuals, markets to sort facts from rumors.
Fuels volatility.
Hugely. The sheer volume and speed can overwhelm traditional news, lead to emotional reactions in markets, make rational decisions really difficult. And finally, we just have to acknowledge the heightened U.S. polarization.
It does feel more divided.
Arguably more deeply polarized than any time in recent memory. And that makes accepting election results regardless of the outcome, much harder for significant chunks of the population.
Which increases the risk of
Prolonged disputes, maybe widespread civil unrest, and just a general wearing away of trust in the very institutions that underpin democracy and economic stability.
So you put all that together, the interconnectedness, social media, polarization.
The implication is pretty significant. A crisis here could go global in hours, making rapid, decisive responses absolutely crucial and leaving very little time for markets or individuals to adapt effectively.
Okay, so knowing all of this, acknowledging that these huge macro scenarios are mostly out of our individual control, what can you, our listener, actually do? How can you protect yourself, your investments? What are the proactive steps